Well, it's that time of year again. Folks are wrapping up brandings, they're turning out bulls and AIing as well, and ranchers are starting to contract their calves, kicking off video auction sales across the country. But the big question is, just what will the calf market be this fall? Agricultural economist Dr. Gary Brester of Montana State University shares with us a short and long-term outlook for the cattle market.
Well, we've certainly seen a record price in 2014, probably close to record in 2015 for feeder cattle. And so the question becomes, how long will those very high prices last? And if you go historically and look back through time, way back through time, you see we've actually seen these kind of prices in today's dollars in 3 other years. It happened in 1951, it happened in 73, and it happened in 1979. In today's dollars, very similar prices. Each one of those events was caused by low cattle numbers in 51, the initiation of the Korean War, lots of concern about shortages of food and starvation, and countries bought a lot of feed grains up and it drove all these prices higher. That didn't happen, thankfully, and we ended up with cattle prices below the long-run average just 2 years later. And that long-run average in today's dollars is somewhere around $1.50 calf. 73, same sort of thing. 1972, the Russian wheat deal, lots of commodities were bid very high. 2 years later, we had prices again below trend as a result of OPEC quadrupling oil prices. Some of your viewers might remember that. I certainly do. I was your age going to college at the time. And then in 79, the same thing happened. Very high cattle prices for similar reasons. OPEC doubled oil prices late that year. Incomes fell from consumers, and again, cattle prices absolutely fell out of bed. 2 years later, they were below trend. Why the long story about history? Well, if history repeats itself, we would expect to see a similar pattern, and we would see much lower prices, let's say in 2016. But the question is, what is the demand side factors that might cause that? It won't be oil. Could it be other things? Perhaps. But I don't think so. And I also don't think we're going to see big enough increases in cattle numbers and supplies to cause substantially lower prices either. Probably a little bit, but not substantially. Primarily, there's two things. Where are we going to find feed for these cattle, both grass and hay assets? And also, how much can I afford to buy for a cow for? If I'm going to expand my herd or retain a heifer, at what point do I think it's worth it to retain that heifer? That all depends upon how long we're going to see these very strong prices. You know, that when we think about the factors that allow for the expansion of cattle herds in the United States, we really need grass. And between drought, the use of land, and many other, both recreation, wilderness, and for cropping, I don't think we have the grass right now to substantially increase the cattle herd. To get our prices down to that trend that I was telling you about of $1.50 or so, we probably would have to add 4 to 6 million mother cows to our herd of 32 million or wherever we're at. I don't think we have the grass to get that far, I really don't. So if demand isn't influenced by recessions, concerns about food safety or any of those kinds of things, I think we've got pretty strong prices for the next couple of years, yeah.
And thanks to Dr. Gary Brester of Montana State for that update. Reporting for the Northern Ag Network, I'm Lane Nordlund.